Professor Kroszner's expertise and talk a little bit about the markets and equities at the moment. So US and global equities have bounced back from the initial tariff shock. What's your read on why that's happened?
So it's always very difficult to assess the market movements. I'll give a stab at that, but there's, as economists say, there's a wide standard error in giving and trying to explain those market movements. So I think there was a shock that came that people weren't expecting the kind of tariff proposals that the president had come up with, even though President Trump had talked about imposing tariffs. People really didn't know exactly what that would look like, and I think they were quite surprised at the extent of them, and it was both the level and the breadth of them. Now, obviously, what happened over time is that the president has proposed pushing back the date for when these would be implemented, for giving more flexibility for negotiation, and so I think that was something that was very helpful for the market to come back. Some other things that have also happened in the U.S. is the president's bill related to the budget and taxation was passed, and that has significant cuts to, or I shouldn't say significant cuts, significant extension of previous cuts to taxes on investment. And that has been very, very helpful on maintaining investment in the U.S. So my colleagues at University of Chicago and others did work on the initial Trump tax plan from the previous administration, and found that the initial expensing of investment was very powerful in giving incentives for investment. And the new bill makes that permanent and reduces the uncertainty around that. So I think a combination of some of the reduction of uncertainty related to taxing of investment, I think greater clarity around the tax proposal, the tariff proposals have helped the markets to feel more confident, and also the U.S. economy has continued to be resilient. The labor market has still been fairly robust. Consumption has been fairly robust, even despite some significant initial drops in consumer confidence. The actual spending numbers have been reasonably solid.
Can I add just add one point, if you don't mind, to this? I think it's very important because there are two things going on here which sort of sit somewhat in tension. One, as Randy said, is the reaction to obviously all the news on tariffs. And the fact that equity risk premia have gone back to where they were before that news came out is a vulnerability. I think it must be clear that that looks like a very compressed risk position. On the other hand, there's this other story that, say, Randy was referring to, which is essentially, of course, particularly in the US, it's a very strong tech-led growth story. And just to give you, here's a striking fact, if you like. The market capitalization of Nvidia is now larger than the UK's GDP. It's up 20% this year. That is a pretty striking fact. It's 7% of the overall market capitalization in the US. So you've got these two stories, these two big stories running sort of alongside each other, and in some ways in a bit of tension with each other at the moment.
Thank you. And you mentioned in your speech about obviously the global threats. That's the big concern for stability in the UK. So how do you think the falling back to April or pre-April, pre-tariff equities is going to impact us here?
Well, just to develop it, I think in terms of markets, one of the other big things that's happened is that we've had a breakdown in what I would call established correlations in markets. So that's another area where we can be quite heavily affected. What do I mean by that? So prior to all of this starting, for some time, you'd had a pretty established relationship, and here I'm talking about the correlation between bond yields, equity markets, and the dollar exchange rate, really. What we have seen since April is that those correlations have sort of essentially broken down somewhat, and the one that's particularly broken down is the dollar exchange rate. So the dollar has depreciated. So at the same time as we were just discussing this story about equity risk premia going back to where they were, the dollar has continued to depreciate. Now, I think there are two things behind that going on. One is that over time, I think longer-term investors who were typically overweight dollar assets are looking again at that and saying, we probably don't want to be so overweight as we were. And so there is, over time, this will take quite a while because these are longer-term investors, so it takes longer to work its way through the system. I think we sense, and we are told by the markets, there is rebalancing going on, which involves a reduction in exposure to dollar assets over time. And the second one is that they were also typically unhedged on their dollar positions, because actually over time it had been a pretty good trade because of this growth story that I was talking about a few minutes ago. And now we are, the message we get very clearly is that there is hedging of dollar positions going on to essentially hedge against that, what they're now seeing as a decline in the dollar exchange rate. So the most crowded trade in the market at the moment is short dollars. And that's, of course, important because 90% of FX trades have got dollars on one side of them. So that's the thing that, again, in terms of impact on the UK, we have to watch it very carefully because this is a major change in market correlation.